Hello and welcome back to another demonstration video dealing with Chapter 1, the equity method. Specifically in this video, we're going to utilize problem number 7. Problem number 7 in your book, and that is should also be on page 29 as well. So problem number 7 deals with the previous learning objective that we talked about, actually implementing the equity method of accounting. But we're also going to look at how we allocate the cost of an equity method investment, how we compute amortization expense to match revenues recognized from the investment to the excess of investor cost over investee book value. What in the world does that mean, right? It's a bunch of words. Basically, we're saying, okay, what happens if an investor pays more than the book value of the investee stock? Okay, so let's turn to page 29 and let's look at problem number 7. It tells us in January of 2023, Domingo Incorporated acquired 20% of the outstanding common stock of Marts Incorporated. They paid $700,000 for it. Now, they tell us that this investment gave Domingo the ability to exercise significant influence over Marts, whose balance sheet on the date showed total assets of $3.9 million with liabilities of $900,000. Any excess of cost over book value for the investment was attributed to a patent having a remaining useful life of 10 years. Okay. Then they go on to tell us, hey, in 2023, here's the net income of $170,000. They tell us that in 2024, Marts reports net income of $210,000. They paid dividends of $70,000 for the 2 years. And then basically we have to calculate, utilizing the equity method, what's the balance of Domingo's investment in Marts Incorporated at December 31st, 2024. Okay. Before we do any of that, what I think we should jump into is determining, is there any excess of cost over book value? And if so, how do we calculate that? Okay. So the first thing we're going to do is we're going to look at, because remember, when we buy a company or when we invest in a company, basically we're investing in the company's net assets, right? That's basically what we're investing in for the most part. So what we're going to do is we're going to calculate the net asset or the net assets. So we know that the assets are $3.9 million. We know the liabilities are $90,000. So when I subtract those two, I see I get $3 million of net assets. Okay, cool. Now remember, we're purchasing $700,000, right? So we have to compare that $700,000 to something. What are we getting? What are we buying? Well, we're buying in stock. Specifically, we're buying voting shares of stock of Domingo, right? So what we're going to do is we're going to say, okay, how much of those net assets are we actually purchasing? Well, we know, because the problem told us, that we acquired 20% of the outstanding common stock. So we're going to take that $300,000 of net assets and we're going to multiply it by our percentage ownership of 20%. We end up with $600,000. Okay, that's the net assets. All right. Well, remember, we paid $700,000 for 20% ownership. Okay, so we overpaid by $100,000. We overpaid by $100,000. Okay. Well, that's okay, because the problem told us any excess of cost over book value, which is what we just calculated, was attributed to a patent having a remaining useful life of 10 years. So guess what? We have to allocate, or amortize rather. So we're going to amortize the $100,000 over those 10 years. So I see that my amortization expense is $10,000 per year. Okay, so that's how we calculate. That's how we determine if there's any excess of cost over book value. Okay, so what we're going to do now is go ahead and solve the problem. Right? What they want us to do is they want us to calculate the investment in Marts as of December 31st, 2024. Well, we can do that very easily. Why? Well, because we know two things. Number one, we just saw in our previous video how to apply the equity method. Part two of our problem here says, well, how do we determine if we overpaid, if there's any excess payment over book value? Well, we just did that. Okay, so first thing we're going to do is we're going to say, okay, what's the acquisition price? Right, so we're going to establish on our books the acquisition price of, and bear with me here for 1 second, $700,000. Okay. There we go. Okay. Now, remember, net income increases our investment in another company, right? If we're investing our cash in other companies, how was that investment account impacted? Well, remember, any net income recognized gets accrued to us, or the investor company. In this case, we're the investor company. So we're going to say income accruals. Well, in 2023, their net income was $170,000. We're entitled to 20% of that. So that's $34,000. 2024 net income. Well, in 2024, the company made $210,000. Well, the Minigo is entitled to 20% of that. So we're going to accrue 20% of the $210,000, which gives us $42,000. Okay. Now over here, we just calculated that amortization, right? So that amortization cost for 2023 and 2024 is going to be identical. It's still going to be the $10,000. Okay? What are we doing here? Well, we're amortizing. Because remember, at the end of the day, what we're trying to do with the equity method is we're trying to, or the objective rather, of the equity method is to report the investment and investment income to reflect the close relationship between the investor and the investee, right? We're doing the same thing here. There's this close relationship we have, right? Because we overpaid, what we have to do is we have to amortize that overpayment. Here specifically, it was geared towards goodwill, okay, or there was an issue of goodwill. So we carry that over to our total column, because remember, what we're doing here is we're decreasing our investment. And remember, the accounts are sexy. Here's why. Bear with me here. Oh, I wanted. Okay, so remember, who are we here? Well, we're Domenico. we're buying marts. Investment in M-A-R-T. Oh. Okay. So right off the bat, our investment goes up by $700,000 because that's our initial investment, right? Net income increases our investment in marts, okay? That amortization, because of the goodwill, because we overpaid, right? That is going to be not allocated. That amortization is actually going to decrease our balance in the investment in marts company, okay? And then finally, they tell us, hey, they pay a dividend, right? They pay dividends. In 2023 and in 2024. And they tell us that the dividends are the same each year. They pay $70,000. So $70,000 in dividends. Well, remember, we're getting 20% of that because we own 20% of marts. And when we run those numbers, we end up with $14,000. So remember, dividends, bear with me here, I'm just doing this for continuity purposes. Now remember, dividends decrease the investment in the company, right? So we're the investor. When the investee pays dividends, we have to decrease the balance in our investment account by the amount of that dividend, okay? So bear with me here. I'm going to make this 10,000 because I don't want these negatives. And I'm going to plug in the dividends here. So I can go ahead and calculate, hey, what's my ending balance? So I add up all the debits, subtract out all the credits. Bear with me here. Oh. So sorry. Don't know what that was. Let me fix the formula here to get it to calculate correctly. Okay, we end up with $728,000. That is the balance that Domenico reports in Mart's company at December 31st, 2024. So our answer is in fact A, $728,000. Okay, so that is how we allocate costs, right? Specifically, what costs are we talking about here? Well, we're talking about the cost of an equity method investment, or I'm sorry, the amortization. What are we talking about? We're talking about compute the amortization expense to match revenues recognized from the investment to the excess of investor cost over the investee book value. I know that's a mouthful. But nonetheless, that, my friends, is how we calculate it. Okay? So thanks for tuning in, and we'll see you in our next videos.